Engine start. 4, 3, 2, 1, and liftoff. Liftoff of the 25th Space Shuttle mission, and it has cleared the tower.
Hello everybody, I'm Zach Snelling, the Group Head of Property Management for Ray White, and welcome to Beyond the Headlines. Now, our economics team will be joining us very soon because we all know why you're here tonight. Since the federal budget was announced last month, there has been a lot of questions, a lot of uncertainty, and a lot of people wondering, what does this mean for us? But tonight's not about politics. It's about helping cut through the noise and explain exactly what these changes are and how they're going to affect you today and into the future. So Australia, you have spoken. There's over 3,000 of you that have registered for tonight's session, and of that cohort, hundreds of questions. Not to mention nearly 240,000 properties under management across Australia, to give an example of our scale. And so what are our investors doing? What are they saying? What are they feeling? Well, thankfully, nothing too dramatic at this stage. We're not seeing any mass panic or mass sell-offs or fear, but there's a lot of uncertainty. The one thing that came true in all of the feedback we're getting so far from our group and from everyone here tonight are the common themes amongst the questions that you're asking. You can see those there up on screen. Should I sell? Should I still purchase property? Are rents going to go up? Is it law yet even? What dates should I be across? So tonight we've got our fantastic economics team to help cut through the noise and give you context and clarity. I think it's important though to highlight that the fundamentals of property and residential tenancies have not changed. Investors on this call this evening, you've been through these sorts of cycles before. We've had changes of government, we've had changes of tax settings, we've had all sorts of regulatory reforms happen before. Now, despite those changes in the past, and the details might be different if we look back as far as 1985, if we go back to Victoria more recently with the reforms they've seen, or even across the ditch in New Zealand in 2001 with the removal of interest deductibility for investors. Despite the difference in all of these changes, the one thing I've noticed in my career is there is something that remains remarkably strong and consistent, and that is the fundamentals of property investment. So let's start with supply and demand. Here is where we are right now in Australia. 2.9 million Australian households rent. That's 31% of the entire country. 83% of those tenants get housing provided by investors just like you, private investors providing those homes. And year on year, we're hitting close to 500,000 net property population growth in Australia. Now, if we look at demand and supply, these figures here, they're the SQM figures from May, so they're the most recent vacancy rate figures across Australia. In a healthy rental market, vacancy rates should sit closer to about 2 to 3%. Those numbers tell a very different story. The supply and the demand is obviously the equation that plays into property investment. One thing I want to ask investors though this evening is to think back and think about the reasons why you chose property investment in the first place and what makes it such a stable and attractive asset class. First of all, it's tangible. You can touch it, you can see it, and there's never not going to be a demand for rental housing from tenants in Australia. Not to mention two sources of income streams, whether that be rental growth or the long-term gains in capital growth and the asset value of your property. And let's not forget one of the benefits of investment properties, which is leverage, which is how many of you on this call have worked towards your financial goals for you and your family. Those fundamentals remain the same despite whatever government changes might be coming into place. Demand remains strong, supply remains constrained, and the long-term drivers of property investment remain intact. Now, before I hand over to our economists Nerida and Atom, I'd just like to finish with a few practical considerations from a property management perspective. What do I think investors tonight should be thinking about if they haven't already? First of all, please review your financing, whether that be talking to a loan market broker or any mortgage broker for that matter, just to make sure you're on the right rates, that you're getting the best return that you can. Also, if you don't have a relationship with an accountant yet, please do so. There's all sorts of implications you could be looking at there in terms of property ownership structures, taxation advice, or even looking at your cash flow through depreciation and making sure you're leveraging that property for your investment properly. Now, finally as well, communication with your property manager. Obviously, we're coming from a network of property managers. This is so important. Please talk to your Ray White property manager about where your head is at now. We need to understand your long-term goals, how you're feeling, what your approach may be, because it impacts things like our tenancy selection and lease length, and we just really need to know where you're at right now with this. So talk to us. But ultimately, all of this is about taking a much more hands-on approach with your investment property, avoiding emotionally driven decisions, and having a strategy and not a reaction. And that is why you're here joining us tonight. You're here to get the answers. You're here to hear from our expert in-house economics team. And first of all, to kick things off, I'm going to welcome Nerida Conisbee, our Ray White Chief Economist. And we'll see you shortly.
Great, thanks Zach for that introduction. So today what I'm going to do is run you through what the budget entails and what some of the expected impacts we think will happen as a result of the budget. And then I'm going to hand over to Atom Gotian, and he's going to talk you through some of the early data we're getting in terms of seeing what's happening in the market, and then talk a little bit about the outlook as well. So just to start with a bit of context, the budget was announced on the 12th of May at 7:30 p.m, so it is a critical time to understand as I go through these changes. But what the main driver of it was around what's been happening to home ownership in Australia. So when we have a look at the number of people that own their own home or have a mortgage, it has dropped significantly over the past 20 years. So it's gone from about 3/4 of households owning their own home to around 68%. So this is the real driver. The fewer people are getting into the market and owning their homes outright. When we have a look at the landlord market or the rental market, we know that 83% of households rent from private landlords. It is overwhelmingly the dominant form of housing investment in Australia to provide rental housing. If we have a look at that remaining 17%, a lot of it is government-owned property. It has been reducing over time. And the other component is primarily not-for-profit. So the other remaining 17% does tend to be focused very much on very low-income households. 2.9 million households are renters. It is a large proportion, around 31% of all households. And negative gearing is or has been a very important pathway to getting rental properties into Australia. So 48% of rental properties are negatively geared. When we have a look at the number of rental properties owned by investors, overwhelmingly investors own just one rental property, 72%. A further 19% own two, and then less than 10% own three or more. So it does show the importance of individual investors in Australia to provide rental housing. And when we have a look at the values of distribution of investors by property value, you can see here that, again, overwhelmingly, the majority of investors do own rental properties priced under $750,000. So it's very rare for someone to own a rental property worth over $2 million. So this becomes important when we talk about the outlook for house prices in particular, because at the moment cheaper homes are outpacing much more expensive homes, primarily because first home buyers and investors are competing for property. But with investors pulling back, we do expect more expensive homes to outpace cheaper homes. So starting with negative gearing, and when we have a look at what that is, it's basically when your investment property costs more to own than it makes in rent. So here in this example, the income from the property is $30,000 per annum, so that's the rent. $45,000 is paid every year on interest, maintenance and insurance, and as a result, a $15,000 loss is made in a single year. So that $15,000 loss can be deducted against salary income. So just say in this example, If someone's earning $120,000, it reduces their taxable income to $105,000. And as a result, if you're looking at a 30% marginal tax rate, it is a saving of around $4,500 per year. So you're really offsetting the loss from your income. Capital gains tax, which is the other major change, is when you sell your property for more than you pay for it. So in this example, a property was purchased for $1 million. It sold for $1.2 million. There was a capital gain of $200,000. That $200,000 in the previous structure prior to the budget, investors received a 50% discount on that capital gain. So half of that $200,000, and assuming a marginal tax rate of $30,000, the CGT is $30,000 instead of $60,000. So it's basically a reduction in the amount of tax you pay once you sell an asset. Important to note, owner-occupiers are fully exempt from paying CGT, provided it is their principal place of residence. So this doesn't apply to the sale of a home that you live in. So these are the transitional arrangements of the capital gains tax. So basically the key date is the 1st of July 2027. So if you own a home, if you own a rental property, there's two methods of calculating capital gains tax. The first one is a revaluation on the 1st of July 2027. So in this example, the property is purchased for $1 million on the 1st of July 2020. Up until July 2027, the property makes a $1 million gain, so it goes from $1 million to $2 million. And under the old structure, you use the 50% discount. From 1st of July 2027, that property is revalued at $2 million, and then from there, the property is moved to an inflation indexed model. So, and at that point, a different calculation of capital gains tax is implemented. In method 2, you can also choose a time proportion. So you can just not do the valuation and you can just split it. So you basically split 7 years and a further 3 years, and just calculate it based on that time using the full increase in the value of the property. So I think this is one thing to keep your accountant across in particular. In some cases, it might make more sense to do a revaluation on the 1st of July. Alternatively, it may make more sense to use a time apportionment. So here are the changes. Negative gearing, what will change? So there is quite a lot of detail here, and I guess the first one is that date of 12th of May at 7:30 p.m. So if you've owned a property prior to that time and you're negatively gearing it, you can continue to negatively gear that property. So there is no change. If you purchased a property after that date, or after the 12th of May, it will be subject to the new rules. So no negative gearing on established property, but normal negative gearing applies up until the 30th of June 2027. So you basically have around a 12-month time period in which you can negatively gear if you've purchased a property after the 12th of May. And then from the 1st of July 2027, if you buy an investment property, an established investment property from that date, you can no longer negatively gear at all. So it completely cuts out for established properties. For new builds, there are no negative gearing changes, there are no capital gains tax changes, and as a result, the tax incentives that were in place before the 12th of May will continue to apply. So how will it change? Looking at capital gains tax, this is just some examples, and in some situations, the new inflation index system may actually result in you paying less tax when you sell a property, primarily because we are in an environment where we do expect much lower capital growth and we also expect much higher inflation. So in this example, with the 50% discount, you can see here that the CGT payable on a property that sold for $2.75 million after being purchased for $1.75 million would pay CGT of around $150,000. In the new model, in the inflation index model, if inflation is 3%, this property would result in CGT of $198,000. But if you're under a much higher inflation number at 5% per annum, it could actually lead to less tax being paid. So this is really important because inflation at the moment is sitting at 4.6%. And so obviously we are in a quite high inflation model. So it does mean that the discount will be a lot higher as a result. The new build classification becomes really important because negative gearing will continue to apply, and capital gains tax will not be changed if you don't want it to be. And understanding what a new build becomes really important. So off the plan is one option. So buying an apartment or a townhouse before or during construction. Vacant land construction, if you do have a vacant block and you put a brand new dwelling, that is counted as a new build. If you increase density, so if you knock your house down and build 2 houses, that's considered a new build. And it must be sold for the first time as a residential premise and cannot have been previously occupied for more than 12 months if it was first owned by a builder or a developer. So this is basically what we know. Atom will talk a little bit more about this later, but this still has to all go through the Senate. But we don't expect major changes to these classifications, even if it does go, even if some of the other aspects of the legislation is changed as it goes through the Senate. So what does it mean for investors? So that if you owned a property before the 12th of May, your property is grandfathered, existing tax treatment is preserved until the property is sold. And then the capital gains tax, as I mentioned before, the 50% discount is retained on gains arising before the 1st of July 2027. It's then inflation indexed after the 1st of July 2027. If you are buying brand new, no changes to negative gearing. You can still negatively gear a brand new property. When you sell, you can either choose the 50% discount or you can choose the inflation index. And then for those buying existing from the 30th of June, from 1st of July 2027, the new rules take effect. So you can no longer negatively gear a property if you buy it from the 1st of July 2027. In terms of capital gains tax, it will be inflation indexed rather than the 50% discount. So what does that mean? I guess the first point would be that if you've owned a property, if you've been negatively gearing it and you've owned it before the 12th of May, there is a strong incentive to hold because you will lose the grandfathered negative gearing if you do decide to sell. If you're looking to buy new, I think probably you do need to look much more closely at the asset. You need to look particularly at the rental yield will become more important, primarily because when you look to sell that property, the new build is only new once, and there may not be such a large buyer pool for that property compared to the previous system where all properties were able to be negatively geared. And then if you're looking at buying existing, we do expect to see far fewer investors in the existing market, pretty much until we start to see rental yields reach a level at which it becomes sustainable. We also think that rent vesting will become largely unviable for many younger buyers. We know that a lot of younger people were using rent vesting and were forgoing first home buyer incentives because they were able to take advantage of a lot of those tax breaks. What it means for owner-occupiers, negative gearing, you can't obviously negatively gear a property that you live in, and also capital gains tax doesn't apply. So it could lead to more value to the family home. We're not quite sure what the ultimate impact will be. We do expect to see fewer investors buying, and as a result, it will take pressure off pricing for cheaper homes. And we also expect to see fewer investors selling, particularly those that were able to, or who are taking advantage, or using negative gearing to hold on to the property. Bad news for renters. I think this is probably the main impact. We do expect to see fewer investors. Obviously, many renters will become owner-occupiers, so there will be a little bit of pressure coming off from that perspective. But it does also it doesn't take into account the fact that we continue to see more renters entering the market, and it's not a simple swap that all renters will become first home buyers. Also a location mismatch. When we have a look at where we expect to see more investment, most new homes are built in outer suburban areas and also built in apartment precincts, and not necessarily where renters need to live. So basically the analysis that we've done looking at Melbourne in particular, where we have seen a lot of additional taxes put on investors, where we have seen a big drop in the number of rental properties. So in 1 year we saw a 20,000 decline in the number of rental properties in Melbourne. We did see the pressure on house prices move to rental growth, and as a result, price growth did moderate. It was partly these taxes, also very high levels of supply. Price growth was only 10% over the past 5 years, but rental growth was 35%. So it really just shifted the pressure from prices onto rents. So I'm now going to pass over to Asham Gautier, and he's going to run you through the property outlook.
All right. Thanks, Nerida. And thanks to Zach for putting this whole webinar together. So it's in my part of the presentation, I'll be breaking it down into 3 segments. So I'll first be discussing where the market is now. Then I'll be taking a look at the short-term drivers of growth that we've seen over the last 12 months. And then finally, the third part is I'll be looking at the longer drivers of growth, really breaking down what media would call the fundamentals of the market. After my segments, I'll be looking at the top questions we've received from you, inviting Nerida and Zach back on board to help me answer them. So I'll start out with this map. And so we're taking a look here at the median house price of all major cities compared to Australia. So Australia as a whole has a 1.03 median house price with 14% growth over the last 12 months. So this is actually a really massive growth, really driven by Perth, Darwin, and Adelaide and Southeast Queensland. So these are fueling the national figures we're seeing. Sydney and Melbourne over the last 2 to 3 years have been seeing much more muted growth. So Sydney, of course, is the most expensive capital city. Growth has just been at 1.8%, while Melbourne has been at 958,000. So going through its own challenges. The unit market is showing a similar narrative. So the median unit price in Australia is $752,000, and growth over the last 12 months has been at 10%. So very strong as well. And mirroring your house market, this growth has really been concentrated in your traditionally, outer growth areas. So Perth, Adelaide, and even Southeast Queensland. Meanwhile, Melbourne unit prices have stayed flat, and then Sydney at 1.7%. The important thing to note here before we continue with the rest of the presentation is that there are different data providers available. So the 3 main ones we use are Cotality, PropTrack, and NeoVal. And there are huge variations, as you'll see, in the smaller markets such as Darwin and Perth. But in the more major markets, the story is quite consistent. So really in Canberra, Melbourne, and Sydney, and you'll even see for PropTrack and Cotality, they have a capital city index. And so these are showing that from April to May, house prices have dipped, and it could be early signals of slowing growth for the year. I'll break this down further. So the data we use is from NeoVal, and so here we take a look at the 12-month growth over the last 10 years and how this has changed over time in different periods. So currently you will see 14% for house prices and then 10% for unit prices. And this is actually historically a very high point, excluding your pandemic spike. So Australia at this very moment is actually coming from a very high point. And so price growth is positive, but you may see that it is slowing down, accounting not just for the budget policy changes that we are discussing now, but as well as inflation and your Middle East conflict, which has affected our oil prices. So house prices nationally are overwhelmingly positive, but we are seeing it slow down. This is that same chart, but then focusing on your absolute median prices. So again, your median house price sitting at 1.03 million, up from 496,000 10 years ago, and your unit prices at 752,000, up from 464,000 10 years ago. And so you'll see that this has just been a gradual increase over the last 10 years. Between between May of 2025 to May of 2026, this is your house price breakdown by SA4. So SA4 are your major regions within your capital cities. And so Sydney, being the largest capital city, has more SA4s, but we've also included Perth, Brisbane, and Adelaide. And you'll see that the trend we're seeing is that premium regions, or SA4s that have a higher median house price, are seeing the biggest house price falls in May. And so this really explains the fact that your top market buyers tend to be more flexible. When there's uncertainty, they're the fastest to pull back, and when times are good, they're fastest to enter. And so at this moment, premium regions are seeing that biggest pullback. You'll see that your yellow column chart reversing as the median price decreases. But so we are seeing early signs of slowing down in growth through the premium regions. You may see in the media as well that a lot of comments around correction leading to 10% over the next 12 months. But the thing is, we're coming from such a high point in terms of prices, both for houses and units, that a 10% correction only brings us back to early 2025, really. So if we assume where we are now as the peak, so 1.03 million for house, a 10% correction by May 2027 brings us down to $927,000. So that's the 10% correction that that we're seeing as a worst case scenario over the next 12 months. And this, you can see, is where we were in August 2025. Not so bad if you put it into perspective. Meanwhile, for units, we go back to March 2025. The key metrics we're looking at to anticipate growth. So prices, we tend to see captures activity after the fact. So there are two key metrics that we're looking at to try to anticipate where the market will be going. The first of which is provided by our partners at NurtureCloud. So this is your open home attendance. So the number of people attending your open homes. And you will see that on average, this has ranged between 3 to 4 people over the last 3 years. So we're comparing monthly data for 2024, 2025, and 2026. As of May, we're seeing an average of 2.35 attendees per open home. And you can see just how far that's dropped compared to the start of the year. So from 4, we've almost halved to 2 in terms of open home attendees. And this is the metric we're monitoring most closely because it shows us the sentiment of people. It tells us how people are feeling at the moment. And this is telling us that people are being very cautious. They're trying to observe first before they act. Even comparing to previous years, 2024 and 2025, May is you will see that as from the start of the year to the middle of the year, attendees normally drop, but in this case, in 2026, it's dropped much further. Again, not just because of budget policy changes, but then you've had rising interest rates and, of course, your global conflict. Another metric that we like to observe to help us anticipate where the market is going is your time on market. So this is how quickly people are acting, how quickly a property goes from enters the market to how quickly it leaves the market. And so at the moment, both houses and units are identical at 27 days on market. And you'll see historically, over the last 10 years, this is quite a good a low period. Again, excluding the end of your pandemic when people flooded, when buyers flooded the market. So we haven't seen any changes for this, but we are monitoring this on a monthly basis to see, how far people react. So at the moment, no changes for median time on market. Rents, of course, is another important metric. Nerida touched on it earlier about how we are the biggest loser we are expecting from the budget policy changes are your renters. And so over the last 12 months, we are seeing across all major cities, rents are increasing. For houses, Sunshine Coast and Hobart are seeing the greatest increase in rents for houses. Meanwhile, for units, there's Darwin and Perth. So again, Melbourne mirroring its broader house and unit market has a more stable rent growth. So again, breaking down those different buyer types in terms of lending activity. So this is data we get from ABS. It's quarterly data, so we aren't able to monitor it as frequently as we would like. So this chart that we're showing here was updated for the quarter leading up to March 2026. So not yet reflecting the budget announcement. But already we are seeing that there is a dip in the lending. So for across all buyer types, you have your owner-occupiers, investors, and first home buyers. The last quarter has shown a dip from, again, putting it into perspective, peaks for most in terms of lending activity. Owner-occupier and investors were at their peak in the quarter leading up to December. We'll be breaking down. I'll be talking about this more later on, but 2025 was an especially strong year just because of we saw multiple rate cuts and the introduction of the 5%, extended 5% guarantee scheme for first home buyers. So in particular for first home buyers, you will see that spike in lending activity just because of the announcement in October of last year. So this will be updated again in the quarter leading up to June. So that's something we're going to be anticipating, help us understand just how far the impacts of the budget policy changes are going. All in all, it helps us to take a big picture to where the market sits at the moment, to really contextualize where we feel it will be going in the next 12 months and even next 5 years. So this is showing your chart, we call 12-month rolling sales. So this is the 12 months of sales leading up to a particular month. And this shows us the trend over the last 20 years, right? So it's natural for it to go up and down based on how the markets and economy is doing. In times of uncertainty, such as the 2008 crisis, and the 2018 to 2019 when there was housing policy uncertainty, and of course in 2022 when there was significant rate hikes after the pandemic, the market volume dropped. And already in the few months that 2026 has given us, we are seeing there's early signs of a drop. It's not significant when you compare it to what we've seen historically, but it will be interesting to see just how far the impacts go, right? But naturally, markets go up and down. Generally what we see is that it helps to break things down into short-term and long-term drivers of growth. So your short-term growth, of course, include your interest rates, inflation, which I will be talking about first, and then we'll be covering your long-term fundamentals of growth. So you'll see that actually your volume has grown from 2020 to 2026, despite that massive spike. 2025, I mentioned earlier, was characterized by multiple rate cuts. And you'll see that in the yellow line over here, where we came from a cash rate of about 4.5, and then that dropped all the way down to 3.6. So this drop was reversed immediately with the first few months of 2026, and that's why we're seeing a pullback in short-term growth. A big misconception, I guess, is that interest rates going up was solely due to the Middle East crisis. In fact, we actually saw inflation pick up in January before anything happened with Iran. So inflation was already picking up, and the challenge here is that now the RBA is struggling with both domestic and international challenges. The market is in fact estimating that rates will climb one more time, peaking at 4.6%. So we're currently at 4.35%. There's an announcement coming up next week, and markets are expecting it'll be a raise, and it'll be holding there for the rest of the year. But this outlook changes frequently, so again, it's something we're monitoring closely to see, your short-term fluctuations in demand. A positive note, though, is we don't expect the RBA to raise rates too high. So we expect to go to 4.6 and hold there. The reason being your unemployment rate, although historically low, so currently at 4.3%, is quite low when you consider the 20 years leading up to the pandemic. But you will notice that it has been rising slowly over the last 3 years. So this is something that the RBA is monitoring just as closely as we are, and we feel that because of this, rates won't go too high. Another big factor for your short-term fluctuations in the market over the last 12 months is, of course, your incentives. I've mentioned this multiple times, but really this chart helps us visualize the impact in terms of house prices. So what we've done here in your black bar charts is we've divided your suburbs under the threshold for each capital city and suburbs over the threshold for each capital city, and trying to capture the house price growth of each of those two markets. So for example, in Queensland, suburbs with a median house price under $1 million grew by 7.9% since October 2025. Meanwhile, suburbs over $1 million grew by 4.1% since October 2025. So that's October 2025 to May 2026. And the gap between those two is 3.8%. So Queensland, you'll see, has had the biggest difference in terms of your first home guarantee incentive impact. And across all states, you'll see that actually suburbs under the threshold have outperformed suburbs outside of the threshold, just capturing that that immediate demand that was fueled in because of the incentive. Important thing to note, though, is that this was a one-time thing. You can't be markets can't be introducing incentives every other month, or you would think so. So moving on to longer-term factors of growth, of course, the main thing when we're taking a look at fundamentals is your supply versus demand. Your supply, of course, is the number of homes coming into the market. And in this case, we've captured it by your total recorded approvals versus your total recorded completions. So, and then your demand is, of course, based on your population growth, which is your dotted line. As you'll see, the population growth has far exceeded the number of approvals and completions since 2008. And it has stayed there since, really explaining the imbalance that we're seeing in the market for why there's so much more demand than there is supply in the market. Where these people come also depend per state. So New South Wales has your biggest increases in your net overseas migration and natural increase. However, it is seeing a decrease in your interstate migration. So overseas migrants are coming to NSW, but locals are moving to other states, particularly Queensland, as you'll see here. Queensland has a growth of overseas migrants, but as well as an interstate migration growth. Victoria is a similar case to New South Wales. So each state is really grappling with different stories. If you remember the map chart earlier, in terms of where growth is concentrated by capital cities, you'll see that it actually mirrors where people are going. So New South Wales and Victoria are losing a lot of people, hence the more muted growth. Queensland, Western Australia are seeing your most massive growth, and so as such, house prices reflecting that influx in demand. The number of people coming in is one thing, but the types of housing that we need to accommodate those people is another. And we are seeing that the preference in terms of household type is changing as well. So this uses census data from 2016 and 2021. So it may not be the most recent, but the thing I want to capture here is the trend. And the trend is showing that we are needing more houses because because of smaller households. So the number of one-person households have been increasing. So from 24% in 2016 to 26% in 2021. Maybe not so massive a difference, but then the census will be coming back, or this new census data will be released next year, and we're expecting that the trend continues even more dramatically. So again, higher numbers of people entering Australia that need more dense housing, which of course Australia isn't able to supply. And the biggest reason for that is your construction costs are creeping up. So, sorry, let's go back. So construction costs, of course, spiked during the pandemic because of the supply chain issues. This has moderated since the last 3 years, but in 2026, we are seeing this increase slowly. So the problem is not behind us at the moment. So still more people are coming in, and it will be a question of how quickly we are able to accommodate those people. But this is a breakdown of the different costs that go into construction, right? So across the board, all segments of construction are increasing, but there are a few factors that are growing faster than others, and I thought it would just be a fun thing to share. So electrical is your fastest growing, followed by timber windows, and metal garage doors. So it just shows you that, the construction costs can be broken down into multiple things, and it's a lot of different variables, making it more difficult to supply these houses that our population needs. So this is my last slide, and I just want to summarize everything we've gone through because there has been a lot of numbers. So number one, prices are at record highs and growth is slowing, but still positive. So we took a look at how our house prices have grown over the last 10 years, and we've done some scenario viewing to see what a 10% correction looks like, and that takes us back to early 2025. In times of uncertainty as well, we do expect volume to drop, so the number of listings and sales do come down. But key metrics to watch to help us stay ahead of house prices is really your open home inspections, time on market, and your listing volume. This gives us a leading view on how the market is reacting. We are not expecting interest rate relief to come anytime soon, but that doesn't matter because the long-term fundamental, which is the supply gap, remains. So Australia is still adding more people than it's building homes. Construction costs, insolvencies, and labor shortages are what's hindering that gap from decreasing. So from that fundamental view that Zach first introduced, this still holds. So we are seeing a lot of short-term changes in sentiment, but that fundamental market position does not change. Finally, with Nerida, we took a look at negative gearing and your capital gains tax. So the TLDR, I guess, is if you already own, you're in a stronger position than you think. So negative gearing is preserved for you. And in a high inflation environment, which we are entering, you could actually be paying less tax than you were in the 50% discount model. Those are your 4 things to remember. I will be heading into the questions. So these are the most common questions we receive from your answers. I'll be answering the first 2, and I'll be inviting Nerida to help me with the next. So first, is it law yet, or could these measures still change? So the negative gearing and capital gains tax changes have passed through the Parliament and House of Representatives. It is currently with the Senate in a public inquiry. And we expect this to continue until the end of the fiscal year, at which point a vote will be held. We are expecting that the majority of the changes will hold, if not minor changes to the bill. But the timeline to expect is within the end of the fiscal year. Second question is, should I consider selling before July 2027, or does holding still make more sense? In this scenario, given what we've discussed around the grandfathering of negative gearing and the potential upside of your inflation index model, it is in favor for investors who are current investors to hold their properties even way after July 2027. We took a look as well as the fundamentals of the market, and this, from an investment perspective, still looks very positive. So from here, I will pass the thing to Nerida, and thank you very much.
Great, thanks Atom. So I'm just going to answer questions 3 and 4. So the first, number 3, is what impact could these changes have on property values and investor demand in the next 3 to 5 years? We do expect house prices to moderate. We haven't got a prediction, or we haven't got a forecast that we put out there, but I think the most bearish forecast has been a 10% drop that's been put forward by Morgan Stanley. I think, though, you do need to keep in mind that a 10% drop would only take us back to around July last year. If you have a look at Australian property values, in a market like Perth, it would only take you pretty much to the start of the year. So overall, we don't really expect a huge impact on property values, but we do expect price growth from that point to be far more moderate than it's been. Investor demand will definitely drop off. We do know that many investors have been relying on negative gearing to make the investment viable. Some investors will move to new properties because the tax incentives do still apply to brand new properties, so we do know that will happen. But overall, we do expect to see a drop in the number of rental properties available to renters, pretty much what we've seen in Melbourne, and also what we actually saw in New Zealand as well when they did have some significant changes. So that's, I guess, the flip side of fewer investors in the market. It then brings us to the fourth point. If I was buying an investment property today, would these changes influence where or what I buy? I think the first point is that some new properties can really make sense. I think the thing to look out for is whether that property will generate a decent enough rental return, because we are unlikely to see the capital growth that we've seen over the past 5 years over the next 5 years. Also, you can still obviously buy an established property to rent out, but I think the thing to note there is that you do need to look again more closely at the rental yield being achieved by that property. So rental yields, we do expect them to increase now, partly because prices will come off a little bit, but primarily because we do expect rents to see quite significant increases. So I think if you are looking to buy an investment property, definitely look at new property. Keep in mind what the yield is being achieved on that property, and also have a look at established property too, but I think again have a good understanding of what the rental return will be on that property. So I'm now going to hand you over to Zach, and he'll talk you through the last 2 questions.
Great, thank you, Nerida. So 5th question up here, will investors seek higher rents to offset the changes, and what could that mean for the rental market? Now, I'm going to answer this one carefully. You've heard throughout the last hour or so that obviously if supply is affected, demand is going to have an impact, and that is going to push rents up in some areas depending on how adverse those conditions are. A few key points I want to make sure all investors watching here, it's not a simple equation of this is how much my costs have gone up, so this is how much the rent should go up. Rent increases should be based on comparable market evidence. I also want to implore all of our investors here to think about the balance between maximising returns and keeping a stable, quality, long-term tenant. There can sometimes be hidden costs with excessive rent increases. Let's say the tenant moves out of the property, you might have the turnover. I mean, we did see obviously those vacancy rates at the moment across Australia, but you could have a vacancy period. You might see a change in demographic of your tenant as well. If those rents keep pushing higher, there's only so much that people can pay depending on how many incomes are coming into that household. So Let's say you've had a long-term stable tenant who you love and you push the rent up too high, they move out, and then all of a sudden to afford that new rental increase, you're now looking at a group of 3 or 4 people. There's going to be fair wear and tear on the property. I think tread carefully, and I think strike a balance, think long-term, think big picture. Yes, your rental income stream is incredibly important to the viability of your investment, as Nerida was just saying, but there are more factors to it, and a little heads up and advice for all investors. No matter what territory or state you're in, I mean, ACT has the most prescribed rules around rent increases, but if a rent increase is deemed excessive in every state, tenants can challenge that through the various tribunals that are there. So just be cautious, look at the many factors, and think about the big picture there with rent increases. Final question here, what are the early warning signs of tenant arrears or vacancy risk? Look, again, we haven't seen that come through yet. Even if I look back to my time in New Zealand when we had huge rent increases off the back of the removal of interest deductibility, there wasn't this relative shift in tenant arrears or this huge increase in that. Thankfully, again, who knows what's going to happen? We haven't seen that yet, but if you're an investor, I would probably say the earliest warning signs are around communication and behaviour. Your tenant who you have a great open communication with might start pulling back a little bit. You might notice things at the property inspection. Obviously, the biggest sign is a late payment or a missed payment. Again, I just have to say to all our investors, have a strategy in place. Start thinking about that now. The strength of your relationship with your tenant and the long-term benefit of keeping a good tenant and working with them through any issues that they might have is the big picture here. That's the stability of your income stream. So just talk to them, find out what's going on. Like we're saying to you, to our property managers, tell us how you're feeling. Talk to your tenants as well. If they start to experience issues and they've been with you for a long time, try and strike that balance, and things will come around. But hearteningly, we didn't see this at scale last time. Now, I think that is us for tonight. I just wanted to say a huge thank you to everyone who joined us for the last sort of hour or so, getting all kinds of deep into the federal budget and the changes and what that's going to mean for you. For all of you, there will be a recording and slides made available very shortly in the coming days by our communications team. Again, a massive thank you to Nerida, a massive thank you to Atom, a massive thank you to all of you for joining us tonight, and I hope we have been able to help you see beyond the headlines. Thanks for joining us.